Francisco, the commodity decline that we saw, was it a one-off or is it the beginning of a correction?
Look, Tom, I'm more inclined to think that that what we saw last week was very much driven by technicals. It was a liquidation of commodity positioning across the board. Commodities were at record length. If you look at the non-commercial, what's called the non-commercial speculative length and the swap dealers length, we were at $140 billion in terms of length for the top 16 commodity markets in the U.S. Just as a reminder, in 2008, we hit $120 billion. So we were well above the levels of 2008. And, of course, we had that increase in silver margins. We had news of India hiking interest rates a little bit faster than the market expected because of the inflation pressures there. And then, of course, the euro came down. So you had a confluence of factors, but no real trigger on that sharp drop on Thursday.
I'm going to work Victor hard today. Let's get Victor in here to look at this. This is oil. This is Brent. And you can see it roll over. Here's the collapse. And you can see how we've nicely come back. We're not back yet, but we're making our way back. Let's bring up dreaded first chart. And as we do that, we will look at the same Brent complex, and you can see the rollover here. Brent crude back to March. We're back to March. That's all we're back to. I mean, it's a blip, Francisco. Do you see anybody beginning to talk about changing their allocations into commodities?
No, we haven't seen that yet. And in fact, I think that this is a short-term buying opportunity. For those wanting to get into commodities. You still have from a fundamental perspective, you still have the same factors that were pushing commodities up in the first few months of the year, still there. And if anything, I mean, you mentioned Brent being up 4% today. Gasoline is up 5%. There is very strong backwardation also in the gasoline market, 11-cent backwardation. Again, meaning that there is a strong premium for immediate delivery. Inventories of gasoline in the U.S. are very low. So I don't think the fundamentals are necessarily pointing to a sharp drop here. The physical market for oil is pretty tight right now. When you look at all the commodities, Francisco, which you follow, you talk about short. It's about demand and it's about supply. Is it a general statement that across all of commodities, supplies are generally light or we're just short of supply? I think that's pretty fair comment, with the exception, of course, of U.S. natural gas, where supplies are very abundant. Most other commodity markets are reasonably tight, and we've been trading on what we call a demand destruction path. In other words, looking for higher prices to bring in a balance between a very tight supply situation and growing demand. Have they done that? Markets. That's critical, though. Have they done that? Has the demand destruction come in? We've seen some signs, some very thin signs, but not the full-blown 2008 type demand destruction events that we witnessed in the second and third quarters of that year. We've seen just very small signals. Like, for example, airline ticket prices have gone up quite a bit, and we've seen a drop in what's called passenger load factors, which are utilization rates of airlines around the world. We've seen a bit of a drop there, but nothing major. I'd say that demand is still holding up reasonably well, Tom. Let's look at oil here long term. This is one of our favorite charts. It's a heritage chart. Real oil is still unreal. This is inflation-adjusted oil. And the takeaway here, folks, is look in the 80s, and then the OPEC collapse, that little spike up is Persian Gulf War, and then up we go, and we get real pointy, stochastic in 2008, and we're still elevated even with this pullback nicely above where we've been for years and years. Are we going to have that demand destruction come in? Or do we just assume it's going to be a more persistent price here this time around? I still think you're going to need persistently higher prices to generate broad-based demand destruction in commodities, Tom. Now, one of the things that we have ahead of us is the end of QE2. Now, if the Fed stops stimulating the U.S. economy as it has, if there is less flow of dollars into the world economy, maybe we have a bit of a softer patch into the third quarter, fourth quarter of the year. But remember, emerging markets still remain first and foremost constrained by a lack of supply availability. Now, the simplest way to think about this, Tom, is policymakers around the world want to make sure that the world economy goes from $60 trillion to $90 trillion in 5 years, Tom. There is no way we can grow global oil supplies by 50% in line with the nominal GDP growth that we're expecting to achieve over the next few years, Tom. That's the bottom line.
Here, bring up chart 3. You did some great work, Francisco, on can you make money in commodities? Okay, and the answer is, folks, when you look at his sensitivity analysis and his Sharpe ratio and all this other fancy stuff, that you ought to be in commodities. Or, Francisco, is it the gift of low real yields? Are we seeing a commodity boom because the central banks have given us a low inflation-adjusted yield?
I think it's a combination of both, Tom. I mean, we have a supply environment that is pretty tight, and then of course central banks, as we know, have responded to the shortfall in demand in other parts of the economy by giving us a very negative real yield. And let me just give you a simple example of something that happened to me recently on a business trip. I stopped over in India, and my Indian clients were telling me, you know, Francisco, these oil prices are pure extortion. We can't keep on paying these high oil prices to the Saudis and the Russians. This is too much for us to sustain. And what they're saying is, our real income growth is starting to be affected by the very high energy prices. Then when you stop over to your point in the Middle East, the view in the Middle East is a little bit different. People are saying, look, as long as we have a negative real yield on risk-free assets, our incentive to monetize our oil reserves is pretty low. We rather keep our oil on the ground, and we prefer that you guys actually bring slower economic growth rather than us giving you more oil for a lower price. So I think ultimately that's what it boils down to. It boils down to real interest rates. And as long as the Fed stays on hold, commodities will be supported.
Well, these are developed economies. Let's bring up the most shocking inflation chart in the world. And I don't mean cotton, which we'll talk about Civil War highs there. Here's China. And I'd forgotten, Francisco, this is an amazing chart. That line over there on the right side, folks, is at 10% inflation. So you see the first surge coming out of 2000, and then you see the second surge. I mean, they don't have the voice that the Indians have or the oil tycoons in the Middle East have. This is the people of China who have to eat. How is this going to play out within your global analysis?
Well, Tom, remember one thing. Inflation in China is surely picking up, but real wages have been very, very strong in China, too. We've had 15–20% nominal wage growth across most of China. We've also seen the RMB yuan appreciating, which means that Chinese can afford goods from the rest of the world at a lower cost. So I think that when you look at real income growth in China, it's been pretty good overall. In fact, the Chinese have been destocking commodities for the last few months as the PBOC was tightening. And probably we are beyond that point. I think at this stage, with the drop in commodity prices over the last few weeks, it's attractive again for many companies in China to start accumulating commodities again. So I don't think the story for China is over yet. It's still very much alive and going. Yeah, you wonder what Ethan Harris says, folks, about real wages in the United States. Earlier this morning on Bloomberg Surveillance, 7 to 10 on Bloomberg Radio, I spoke with Liaquat Ahmed of the wonderful book, The Lords of Finance. Michael Darter was on the show. He's like, yes, I get to speak with Liaquat Ahmed. How cool is that? And it was great. I asked him if we're in a new time of inflation.
We're in a time of inflation in emerging markets. I don't think we're in a time of inflation in Europe or the U.S., but certainly in emerging markets because they've tried to keep their currencies low and sterilize the reserve inflows that have occurred as a consequence of undervalued currencies. I mean, you got the new idea here, Francisco, of a new inflation, and there's people worrying about that. I don't hear that from you. Why don't you agree we're in a time of a new inflation? Well, I mean, a time of a new inflation for emerging markets, I think the answer is yes. I mean, emerging markets are experiencing fast growth and relatively high inflation, but the developed markets aren't. I mean, this is a two-tier global economy, and commodities sit
at the center of this tug of war between developed markets and emerging markets.
Right.
So that's where I think we are. I think commodities are that nexus between EMs and DMs.
I like that, Francisco, but what about the word leakage that economists use? Can we get some of that inflation to leak back over to us?
We've seen some of it, Tom. We've seen headline inflation picking up in the U.S. and Europe, but at the end of the day, this is a very different environment to what you had back in the 1970s, where there was wage indexation and higher commodity inflation translated into higher wage inflation, which in turn translated into higher commodity inflation again. That is probably true for China. It's probably true for some emerging markets where you have these constant wage pressures building, but you don't have them here. You don't have them in Europe.
Yeah.
We have a pretty decentralized economy.
So one of our themes of the hour, you're saying this is not the 1970s for the United States.
I don't think it is at all. It's a very, very different environment. Now, this doesn't mean that you're not going to feel the inflation in your pocket when you go out and fill your car tank, right? I mean, gasoline is getting more expensive, but the rest of the goods in the U.S. economy are not, right? I mean, your iPad 2s are getting cheaper on a relative basis because now you have more gadgets for the same, or more better quality for the same price. So you do have that trade-off, I think, where some parts of the U.S. economy are still disinflating. Some parts of the U.S. economy, particularly those related to emerging market growth, are seeing a little bit of upside pressure.
All right, let's bring up this note of the day, pushing against Francisco a bit. Michael Darter was my guest host on Bloomberg Surveillance this morning. Our model for commodity prices based on China M2 EMBI risk spreads suggest we could be in for a much deeper industrial commodity price pullback than widely believed. Francisco, do we really know the commodity inventories of China?
It's not widely publicized now. I mean, the numbers is always, with China, it's always a bit difficult to get a sense of the inventories. It's always about anecdotal reports, and rather than having a full-blown picture like we have in the U.S. or Europe. But if you look at the inventories, even in the OECD, Tom, inventories for oil in Japan, in Korea, in Europe, even in the U.S., they've been dropping pretty quickly in the last couple of months on the back of this whole Libyan supply shortage. So I can't imagine China being any different, particularly because China is very sensitive to reducing inventories on high prices. They tend to do that all the time, and they restock when prices drop. So we don't have, the answer is we don't have a full picture for China, but we know what's going on in the rest of the world, and that points to lower inventories for many commodities.
Well, just finally, here, 30 seconds, Francisco, your oil call for this year. Where's Brent going to be?
Well, we are still looking for $122 a barrel this quarter, and then as we go into the second half of the year, we have a declining price path, a little bit lower than that. We're thinking around $102 a barrel on the back of increased Libyan supplies, and if Libya does indeed come back, and then some of the risks from QE2 or the Eurozone periphery materialize. So 122 still there for this quarter, and then coming down a little bit into the second half of the year.
Wonderful. Francisco Blanch, Bank of America-Merrill Lynch, thank you for getting us started here on our hour of inflation.